Imagine that you bought a single stock, only for it to suddenly crash overnight. Scary, right? That's why diversification matters. There's a well-known saying, don't put all your eggs in one basket.
Let's go through different asset classes.
Bonds. When you buy a bond, you're essentially lending money to someone, usually a government or a company, government bonds and corporate bonds as they're known. They then promise to pay you back the amount that you lent to them, plus interest. The interest is often called a coupon rate, or yield. Bonds are generally seen to have lower risk and lower reward than equities, but they're not risk-free.
Government bonds are issued by national governments. These bonds are low risk and provide stable returns. Corporate bonds, on the other hand, are issued by companies. They offer higher yields than government bonds, but carry more risk.
Equities, stocks, ETFs, funds. Equities, also called stocks or shares. Investing in shares of AstraZeneca or Apple means that you own a tiny piece of a company and become a shareholder. If Apple does well and grows its profits, your shares should become more valuable over time. Instead of buying Apple shares, where you take a risk of iPhones not selling and many tariffs risks, you can buy 500 biggest U.S. companies by investing in S&P 500 ETF. Invest across different countries or sectors, for example, technology, healthcare, finance, and energy. Use exchange-traded funds, ETFs, or mutual funds for broad market exposure. You can also choose actively managed funds. In this instance, portfolio managers are choosing the best companies for investment. Portfolio managers select equities for their funds by analyzing factors like a company's financial health, industry position, growth potential, and market conditions to align with the fund's investment strategy and risk profile.
Foreign exchange, FX. Holding different currencies protects against currency fluctuations.
Commodities. Gold, silver, oil, and agricultural commodities hedge against inflation and may provide security during economic downturns.
Cryptocurrencies. Crypto is volatile but can offer high returns. Diversifying across different coins can reduce risk. Beyond traditional stocks and bonds, there are also other asset classes. Real estate, venture capital funds, invest in startups, and many others.
Cash is an excellent choice in a recession. You can find some amazing deals here with over 4% from JP Morgan Chase in the US. UK's HSBC also offers attractive rate.
Investments carry different levels of risk. Here's a breakdown, from the safest bonds to more volatile investments.
During the dot-com bubble of the early 2000s, many investors had all their money in tech stocks. When the bubble burst, they suffered huge losses.
In summary, investing is all about managing risk while maximizing returns. Thank you for your time.